This podcast channel is about you, successful international entrepreneurs, successful expats, successful investors. Sponsored by HTJ Tax.
So, good morning, good evening, good afternoon, depending on whatever part of the world you are. Welcome to our live stream. So, I'm live streaming on several platforms. Thanks for sharing some of your time and joining us this evening, or morning, or afternoon, wherever you are. Now, thank you for sending in your questions in advance. So that's been really helpful to those who send it in. Some people sent it in last week and some people sent it in like 5 minutes ago. So I've checked my email 5 minutes ago. So if you've sent it in since then, sorry, I probably won't see it. So in terms of some admin, we are obviously recording this as well. So if you don't want your image to be part of that recording, please keep your camera switched off. And of course, because I am licensed by the federal government under Circular 230, which is one of the Treasury circulars, I'm legally obligated to remind you that I may be a tax consultant, but I'm not yet your tax consultant. So treat this as an educational piece. We're having a general discussion about general principles, which I sincerely hope would help you as you try to work with your own chosen tax professional. So again, nothing I say here should be construed as advice. And more importantly, nothing here should be construed as me encouraging you to pay less in your fair share of taxes in any jurisdiction in which you are exposed. Again, thank you for joining us. So the first point is that you guys wanted me to touch on was crypto. I guess like most tax professionals who deal with higher income earners, our team has been inundated. It's like, I'm not kidding, every single day, it feels like we are getting approached by someone who's done well on Bitcoin specifically, or crypto in general. You know, they made 1.2 million, 3 million, 5 million, 9 million, I think 18 million a few days ago. So they're sitting on some capital gains. Some people are short term, some people are long term, and they wanted to have conversations about their options. But there's one thing that I think that everyone should walk away with, and that is, do not try to hide it. Do not try to deny it. If you have been holding or trading crypto, please disclose it. You would have noticed that for those who have looked at the new 1040 forms, that just at the very top, it does ask you outright, have you been exposed? Have you been dealing in crypto? And, you know, just be completely honest. And I, as I've been telling people when we've had our introductory calls with clients that we're onboarding, that yes, the IRS has been severely under-resourced. As of, I think it was December last year, they had something like 12 million pieces of unopened mail. There's a huge backlog. Many of our clients are complaining that returns that we submitted in 2019, paper filed, still have not been processed. Things are really bad because of the pandemic, because of lack of resources, because of the ongoing health protocols that the IRS has to observe. That is true. But guess what is the one area where the IRS has been given permission to recruit? No points for guessing, crypto. So they have on board, we did see ads in certain platforms where the IRS was recruiting contractors, I think sometime the beginning to the middle of last year. So they do have not only the personnel, but they have the technology needed to track crypto transactions. Don't mess around with it. We know that there are tax professionals that play what we call fast and loose, that they encourage you or they facilitate or they turn a blind eye to certain things And let me explain how that comes back to bite you. So just like you've seen on movies, when someone is found to run afoul of the rules, one of the first things that the authorities would do is give them an opportunity to cooperate. For those who are on Netflix, if you've seen the college admission scandal movie, it's a similar situation. So for example, you've had crypto gains, and somehow you've tried to avoid reporting it. The first thing the IRS, when they find you, is going to ask who helped you. Name the professionals, because the IRS is big on finding enablers, who they call enablers. So other tax professionals, other financial professionals who uh, offer the service of attempting to basically evade taxation. And once they find one of those enablers, what they do is check to see whether there's a pattern of, uh, of misbehavior. And they do that by basically auditing all their clients. So if it is you go and you onboard with a tax professional who does not play by the rules, then at some point, one of their hundreds, if not thousands of clients will get caught out. I mean, statistically speaking, given the kind of resource the IRS is throwing behind this. And when the IRS does catch up with that enabler, they will immediately start checking all their other clients, which would include you. So, so you know where I'm going with this. It makes zero sense to try to hide. Now, so we have been, if it is unintentionally, or intentionally, depending on what your situation is, you have not been 100% transparent in reporting in the past with the IRS. There are programs that allow you to come forward to the IRS before the IRS finds you. So every month we take probably 3 or 4 clients through their amnesty programs, their amnesty in all but name. The most popular of which is called the streamlined compliance procedure. So all our clients are internationally exposed. So we take clients through the streamlined foreign offshore procedures. What that means is that for those clients whose non-compliance has been deemed to be non-willful, and we go into that term in a bit, the IRS allows them to, again, referencing the statute of limitations, to look back 3 years for tax returns and 6 years for FBARs. FBARs stand for Foreign Bank Account Reports. And again, that is not new. Ever since the early 1970s, anyone that's US exposed had to report financial accounts held outside of the US. So anyway, so we take clients through that. And for those whose non-compliance is deemed to have been willful, in terms of the definition of willful now, unfortunately, we can't rely on the tax code, so we need to rely on case law. So most attorneys that you speak to would reference United States versus Sturman, or United States, or Cheek versus United States. Basically, willfulness is a voluntary, intentional violation of a known legal duty. So in layman's terms, basically, you have demonstrated intent to evade paying taxes. If you do fall into that category, and probably every 2 to 3 months we do find someone who does fall into that category, we immediately introduce you to one of the law firms that we deal with, because that's when you definitely need legal advice, because the stakes are pretty high. So there is a process for coming forward, don't get me wrong, but you need the support not just of a tax team to actually prepare the returns, but of a competent and experienced legal team to help you negotiate basically with the Internal Revenue Service. So we work with clients who find themselves in either the willful and non-willful situation. For those who are thinking about, and again, we deal with probably 2 to 3 clients each month who give up their US passport or green card. We take them through the process of renunciation, and we introduce them to qualified teams of professionals who are recognized and accredited when it comes to working with clients who want other residencies or other citizenships. When you Google second citizenship or citizenship by investment, as the case may be, you get thousands of results. You don't know who to work with. Most of those people are not qualified. They're introducers, more or less, or brokers. And so basically they point you in the direction of the real professionals who would pay them a commission. And so they would follow the commission lead, right? They're not necessarily putting your situation first. They would follow naturally the profit incentive. So we work with teams that are qualified and recognized and put the clients first. So that's something else that we've been working with. People who have done well in crypto and they are in the process of giving up their citizenship and green card. If you guys want to have that conversation, please reach out to me offline and we can set up an introductory call. So again, I'm just going through the questions that have been submitted. If you have questions, please feel free to type them in the box below. And once I go through those that were already submitted up until, like 15, 20 minutes ago, I will get to yours eventually. So that's it. I mean, the takeaway when it comes to crypto, don't believe those people that tell you can hide. If it is that you have not been 100% transparent with the IRS up until this point, there are options available for you. Once you get to the IRS, before the IRS comes to you, reach out to us. We can walk you through your options. So don't be afraid. You need to come forward as soon as you can. For those who may not, on the other side of the spectrum, not necessarily a crypto millionaire, but a 5-figure location independent professional or 5-figure freelancer who is operating internationally, we don't necessarily work with you, but I've written a book or two which would help your situation. The one on international tax, I think, is a great primer for situations such as yours. Essentially, what you're looking at is the biggest gift that the code allows for someone who may be in the 5-figure space and working internationally is something called the foreign earned income exclusion, which is the benefit of code section 911. So the foreign earned income exclusion, there are two ways of qualifying for it, but just to cut to the chase, you get to exclude up to, and the amount moves with inflation each year. So for 2020 returns that we're doing right now in 2021, you can exclude up to $107,600 from the US tax net. So that's an incredible benefit right there. Plus you get a housing deduction on top of that. So it can go, depending on where it is that you may be based, it could be up to $120,000, $130,000. So it is something that you need to pay attention to because it can be pretty significant. If it is that you're still paying self-employment taxes because you are a 1099, you're just a freelancer, you have an LLC and you report everything in your Schedule C. Again, we have a relatively easy way of legally avoiding that self-employment tax, and that is by incorporating an offshore company. We're getting to offshore companies a little bit later on, but again, depending on what your tax liability is in terms of that 15.3% self-employment tax, it's a bit of a math calculation whether that 15.3% is more or less than the cost of creating and running an offshore structure. For many of our clients, it would be. So therefore, we work with them to do that. The next question that someone raised was, let's see, deductions, expenses. So, right. And the US tax code is pretty specific. We're looking at section 162A, which is telling us that you are allowed to deduct expenses that are ordinary and necessary to your line of business. Now, the US is a bit different from other jurisdictions. For those of you who may be in other common law, ex-UK colonies, the tax code, so for example, in the UK, Australia, Singapore, Malaysia, Hong Kong, New Zealand, Canada, it's perhaps differently interpreted. The code says something similar to wholly and exclusively, but in the US, it's ordinary and necessary. So just keep in mind some slight nuances, which means that, and we get into the offshore company bit later on, that sometimes as you create your offshore structure and you're doing your income statement, you're doing your P&L, there are expenses that may be allowable in that foreign jurisdiction that may or may not be allowable when you're doing your books for the US, for your US tax returns. So just keep that in mind and work with your chosen tax professional to make sure that you get that right. So again, expenses need to be ordinary and necessary to your line of business. I know you guys are traveling, you're doing business overseas. Keep your receipts. Keep your receipts, and you're allowed to keep them electronically. Many of our clients use the online cloud software solutions like QuickBooks and Xero, and it allows you to you take a snap of the actual receipt and you can upload it with the transaction, so you can retrieve it and it's archived for years to come. So please keep track of your receipts, and your expenses need to be ordinary and necessary. And again, circling back to traders, we do have clients that are actively trading in crypto, so they're not just buy and holds, they're actively trading, and so they basically their business is trading in different cryptocurrencies. And again, those are the expenses that you would need to keep track of, and we've been working with some clients on that. So who's next? Again, feel free to type your questions below. I see them coming in. I'm an independent contractor working in Ethiopia, blah, 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 apartment, commission, pay taxes in the US, right? So again, so if you're an independent contractor, that means you are not working through a company. So whatever it is you're working outside of the US, so working in a from a US tax perspective as an independent contractor, there is very little difference from the IRS perspective in terms of recognizing that income, whether you are in Atlanta or in Africa. So it really doesn't matter whether you are on US soil or outside of the United States. Outside of the United States, you need to declare your worldwide income. In the United States, you need to declare your worldwide income. It's all the same to the IRS. That from a revenue recognition perspective, they're not really bothered either way. You're declaring your worldwide income. Now, you mentioned that you're an independent contractor. Just like if you were in the US and you were a 1099 contractor, you declare it on your Schedule C. And it may trigger self-employment tax, as we mentioned earlier. So again, it makes no difference. So the difference is, as I mentioned earlier, that you get to benefit potentially from Section 911, which is the foreign earned income exclusion. So that foreign earned income exclusion can work, depending on your income, to reduce or eliminate your income taxes, depending on your situation, right? Because it protects the first $107,600, $107,600, sorry, from the US tax net. But that's in terms of the income tax. Now, in terms of that 15.3% self-employment tax, it doesn't protect you there. So that's where the whole offshore company comes in. Speak to your preferred advisor, because depending on your situation, it's definitely a benefit that you would not want to miss out on. Next question, I have a tax ID, but I don't want to double my tax payments, the rate of tax, blah, blah, blah. Okay, that's a great point. You are working outside of the US, you're working internationally, you are working in somebody else's jurisdiction. So just like if someone else is in the US and they are working, they need, and we have had a lot of clients because of the pandemic, they were, there was severe disruption in travel, obviously. They were in the US on, for a meeting or whatever, and they could not return to their home country. And suddenly they're caught within the US tax net because of Section 7701's substantial presence. They spend more than a certain number of days in the US. And I'm actually working with 2 clients, one of whom just emailed me because I guess they're kind of panicking. So they're not US nationals, but they were stuck in the US and they have to abide by the rules of the United States tax system. Similarly, when you are outside of the US as a US citizen or green card holder, you abide by the rules of the jurisdiction in which you find yourself. So if you are in jurisdiction X and you trigger the number of days or whatever their rules may be, you file and you pay taxes there. You don't want to get in trouble. Now, your question asks about double taxation. It's good, always good to seek advice and speak to your chosen tax professional. That's always the best course of action. But once your tax professional is experienced, competent, and familiar with international tax, you should not be double taxed. You should not be double taxed. And this has nothing to do necessarily with invoking a tax treaty. It's simply because the United States allows you to, the United States recognizes the system of foreign tax credits. So whatever tax credits, whatever tax you would have paid to the foreign jurisdiction in which you now find yourself, you can use that normally to offset against the US tax liability using Form 1116. So again, speak to your chosen tax professional and you should not be taxed twice. Moving on. Right. Offshore companies. So there's this, and again, it's the media, the media has this, it plays a role, whether it be journalists who don't really understand tax and international law, and they write sensational articles or maybe it's a movie. There's this perception that just by having an offshore company, either you're doing something wrong, it's something nefarious, or you're evading taxes, as the case may be. That is certainly not the case. So the US does allow you. I mean, it's a free country. That's why we love it. It does allow you to hold assets overseas. Then that would include creating, investing, or structuring your own companies outside of the US. All that the US asks is that you report accordingly. So there are certain rules depending on your share of ownership and the nature of the company. It is subject to varying levels of disclosure. Now, bear in mind that just by forming a company outside doesn't necessarily offer any benefit, because you need to think of a concept called nexus. So if it is you form a company, let's say in the Cayman Islands or the BVI or Bermuda or one of, those, or Panama, but you still remain in the US, you basically have a US company because the company is being run from the US. So the company is viewed as having a physical nexus with the United States, so it's taxable in the US. Similarly, if you form a company and insert your offshore jurisdiction here, but you are living in Bali, or you're living in Colombia, or you're living in Costa Rica, well, those countries have rules. They aren't exactly zero tax jurisdictions. So therefore, that principle of nexus may kick in. And if you're actively involved in your key decision maker, so in other words, mind and management, or management and control is being exercised from within their borders, if they find out, they reserve the right to tax you accordingly. And that company therefore may be pulled into their tax net. So you should speak with a qualified advisor before making those kind of decisions. So the point is, just creating an offshore company doesn't magically offer any benefits. It needs to be operated in the right way. And to make sure you're operating that company in the right way, you should always seek tax advice, because there's so many unintended consequences, not just in other jurisdictions, but with the United States as well, because there are a number of what we call anti-deferral rules, and I'll touch on one or two of them later on, which mean that even though you may be outside of the US, so you're not running it from the US, you're running it from, so you set up a company in, let's say, what's a popular jurisdiction these days? Let's say you set up a company in Estonia. People are asking me about Estonia in the live stream last night. So you set up your company in Estonia, and you're based in Europe, you're based in Estonia, you're running it out there. Depending on your ownership structure, it still is reportable to the US, and it still may be taxable to the US, even though you don't get a distribution from it. It still may, under certain circumstances, be taxable because of the anti-deferral rules. And just to keep in mind when you're talking to your chosen tax professional, your US tax professional, you're going to be asking him or her about Subpart F, and that really kicks in a lot with Estonian companies, I think, because Estonia is really popular in Bulgaria, other structures like that. So you want to be asking them about Subpart F. You want to be asking them about PFIC rules if it is you have a holding company or an investment structure, and you want to be asking them about GILTI, or the Global Intangible Low Tax Income Tax, which kicked in under 2017 under President Trump. So there are a number of anti-deferral rules that really make or break, at least from a profit perspective and in terms of your cash flow, the way in which you hold and you manage your offshore structure. So please seek advice. Moving on, offshore banking. Similarly, there's this perception that, I have a bank account outside, and clients, you would be surprised. I was on a Zoom call earlier this week, late last week. I don't recall right now because, it is back-to-back Zoom. Client, husband and wife, doing well. They successfully exited a business in the US, and they're set up now in a Southern European country. And, they throw out the idea, what if I open an offshore bank account? How much money do I save in taxes? It's like, hold on. Just by having an offshore bank account, that does not mean that you're entitled. It potentially has zero impact at all on your taxes. Just because money is stored in a given location, that does not mean it's no longer taxable. Ordinarily speaking, in some jurisdictions it does. So, for example, for those who are under the special regimes, let's say in the UK, where you resident non-domicile, or in Ireland, or the special regimes like that, where it's based on remittance. I think even the island of Dominica, for those who want that tropical offshore jurisdiction, if you're tax resident there, remittance-based taxation is a thing. So you're right, keeping it offshore does incur or infer certain benefits. But with the US, no, it certainly does not. So you are subject to taxes on your worldwide income wherever you receive it. And in fact, under certain rules, under the Bank Secrecy Act, I think, 1970, you are legally required to report all your financial accounts wherever they may be in the world. So again, it's not even going to be secret, because you need to report it to another branch of the Treasury. The IRS is responsible for collecting the data, but it goes to the Financial Crimes Enforcement Network, another team within Treasury. And depending on the threshold, depending on the amount of money, you do report it on the 8938, the FATCA forms, which now form part of your personal tax returns. So it is completely reportable. Even if it's a numbered account, everything is reportable, 100% reportable. So there's definitely no tax benefit. Now, there may be other benefits, because for those of you who are into flag theory, so the flag theory, just to provide context, flag theory is the idea that there's no one perfect jurisdiction out there. No one country is perfect. So therefore, you have several jurisdictions that are good at the things that you need done. So for example, if it is you want a certain corporate structure, then, if it's a fund structure, you may go to the Caymans. If you want to defer the tax, paying taxes until there's a distribution, normally speaking, that's one of the benefits of an Estonian structure, normally speaking. So for certain insurance structures, you want to look at Bermuda. So different jurisdictions are good at different things. When it comes to banking, one of the really great jurisdictions would be a jurisdiction where there are banks that are known to be very, very secure, very safe. and have a high reserve ratio, so they can handle any stress, no high levels of non-performing loans and so on. So you can feel free to Google lots of lists online, but one of the jurisdictions that popularly comes up, and it's a very popular jurisdiction with our network, would be, of course, Singapore, which is where I'm based. So Singapore has some of the strongest banks in the world, and that's why it's a popular jurisdiction for storing wealth, and not just banking, but precious metals and assets of that nature. So again, there's not necessarily a tax benefit for having an offshore account, but you may have other reasons for wanting to store your wealth in certain jurisdictions. And one of them may be observing the principles of a flag theory, which is finding the right jurisdiction for the purpose that you need. Moving on, right? This is another issue that came up recently. So for those who were on the live stream last night, forgive me, I'm going to repeat this. It's the same question, but I think I want to, because it is unfortunately kind of popular. So if it is that you are a US citizen, US green card holder, whatever the case may be, and you spend a lot of time outside of the US, and you spend some time in the US, right? You may be able to file a Form 8802, which is an application for United States residency certification. And then you get a Form 6166, which basically says that it certifies that you are resident in the United States. And in some jurisdictions, particularly those with a decent tax treaty with the US, you can go to the tax authority in that jurisdiction and say, here's my residency certificate. I know I've spent more than the 183 days or whatever in your jurisdiction, but I'm actually a resident of the United States. So that is my place of habitual abode. That is my center of vital interest. That is where my home is. And I would like to be relieved of the responsibility of paying taxes in your jurisdiction. You can do that, but bear in mind, this is based on invoking a treaty. And you are saying under the terms of that treaty, you have a closer connection to the US. Now, I've had clients that approach me and say, can you help me do this? Their friends or people on Facebook do it. And all they need to do is use a relative's address in the US. Now that strikes me as being a bit dishonest and being fast and loose with the US tax rules, because your center of vital interest is not the United States anymore. You have your home in whatever foreign country that is. Your center of vital interest, your place of habitual abode is not in the US. You're using a relative's address. So again, if you do work with a team that allows that, then at any point in time, if they are found out by the IRS, all of their clients may be audited as they look for some sort of pattern of bad behavior, of misbehavior. So please keep that in mind. And we're squeaky clean. We will definitely walk away from anybody who wants us to bend, or if not break the rules. So I just wanted to call that out. Another question that came up, right? So we spoke about setting up a foreign structure, and we spoke about the anti-deferral tax rules that would kick in. One of which is something called a PFIC, or Passive Foreign Investment Company. What is that about? So if it is that you're setting up your structure outside, we see it with people who want to, for example, acquire real estate outside of the US. They rightfully don't do it in their own name. They may use a holding company, and they purchase the asset in that name, or they want to invest in funds or make certain investment in startups outside of the US. We've seen that. So basically, they create a structure to facilitate investment income. It's not a trading company. It's more or less an investment company. So there's a bit of a little test that goes on. So the income test, if more than 75% of the gross income is from that investment income, or there's an asset test, so at least 50% of the average percentage of assets held by that company are for the production of that investment income. So like dividends, interest, rental yield, whatever. So those are PFICs, and they're subject to certain rules. Now, I had a client probably 2 or 3 hours ago. So it could extend into other structures as well. So she or the person is a citizen of a European country as well. So they're dual, both US and another European country and a European country. And they are involved in the pension fund for that, the state pension fund for that European country. And because they are able to acquire shares in various companies or whatever through that structure, they inadvertently have a PFIC as well, a passive foreign investment company. So this is something that you need to pay particular attention to and get advice. And the reason I say that is because it's treated quite punitively by the US tax code. Why? Because I think it started in the 1980s. The domestic financial institutions within the US were complaining that Americans were investing overseas in other, I guess, their competitors overseas. And so I'm just gonna mute somebody who unmuted themselves. Right, yeah. Let's keep ourselves muted, please. So yeah, they were investing in other jurisdictions and they were enjoying tax benefits. So basically tax deferment. So they were able to defer paying taxes until there was a distribution later on. And so they call compounding. So and that was deemed to be unfair. So they rightfully lobbied Congress and these PFIC rules that have come up. So what happens right now is that there's a really aggressive tax computation that goes that may apply if you have a PFIC. And there's a look back rule, and you basically made to pay taxes at the highest marginal tax rate, which right now will be around 35%. So it is pretty draconian in a way. So if it is that you have some sort of investment structure, whether you've an investment structure that you personally put together, or you may be involved in a state pension fund with the jurisdiction, with any other jurisdiction in which you may be exposed as a U.S. person overseas, please speak to a tax professional to make sure that you're disclosing it in the right way. Okay. And right, so precious metals and gold. So we spoke about the fact that if you have bank accounts outside of the US or financial accounts, so that could include ETFs, it could include any pension fund, we spoke about pension funds. All financial accounts outside of the US are subject to disclosure. And that would include not just the pension funds, which we just mentioned, but also other wrappers. So you can, for example, you may have an insurance policy. And the way the insurance policy is structured, the IRS tax rules, it's a foreign insurance policy. There may be a cash surrender value, or there may be underlying investments which you self-direct. Then it will be subject to special disclosure and special tax calculations, right? We spoke about that. Now, if it is you invest in precious metals, again, depending on how you invest in it, then that may not be subject to disclosure. So of course, if you sell it, capital gain or loss would be disclosed, but they just holding the acquisition and holding precious metals, that is one way that some people do legally do not report to the Internal Revenue Service wealth held overseas. And being based in Singapore, which of course is one of the key jurisdictions for storing precious metals, as well as Hong Kong. We have clients in Hong Kong to do the same, and also in Bangkok and Thailand. So that, but again, it can be quite nuanced. So you should touch base with your tax professional, because sometimes you may hold it not with a vault or a secure facility, but you may hold it within a financial institution. And even though it's physical gold, they give you an account number. Sometimes it's kind of done that way, then it will be subject to disclosure. So just touch base with your professional, make sure that you're doing that in the right way. The last point that came up for those who submitted questions ahead of time was, again, going back to this disclosure of financial accounts. What about PayPal accounts, TransferWise, these other fintech? So it's not like a traditional financial institution, but an online or a fintech basically. How do you disclose those? So it gets very nuanced again. So you'd want to speak to your professional, even with something as popular as TransferWise. It depends on what you have. If it is you just have a payment platform, then like PayPal, for example, ordinarily it should not be subject to disclosure. But if like with TransferWise, I think you can get a borderless account and you get an account number, and you might get an IBAN, or you get a whatever, it may even have its own SWIFT code or whatever, then that would be subject to disclosure. So again, you would want to touch base with your professional. Otherwise, if in doubt, report. Because when it comes to reporting financial accounts, remember, it is not included in your tax calculation. It is simply a disclosure. So it does not hurt to just put it on the FBARs, put it on the FinCEN Form 114, your foreign bank account report. Just declare it. When in doubt, report. When in doubt, report. Easy, simple. So any other questions? Again, just feel free to write them in the box below. Just gonna have a look. Nope. I see no questions here. So please just let me know if you have any questions. Happy to answer them. Okay, great. Okay, no further questions. I'm glad that I was able to answer the questions that you guys posed. Again, have a look at htj.tax for all our upcoming live streams. Our next one is going to be on Friday night Eastern Standard Time, or Saturday morning for those in Southeast Asia with us in Singapore. So, and then I believe we have some next week as well. So htj.tax, just click on events and feel free to send us the questions ahead of time, or during the actual live stream, you can just type it in the box below and we'll answer it. So thank you for sharing your time, and feel free to reach out to us at htj.tax. You can connect with me on LinkedIn, and we are on most social media platforms. And this is also turned into an audio podcast, and it's available wherever you find your podcast. So from iTunes to Google Play to Spotify to SoundCloud, I think the marketing team makes sure it's everywhere. So thank you. Good evening, good afternoon, good morning. Have a great day, and we'll see you next time.
Here are 4 ways we can help you. Number 1. Sign up for free webinars on US expat taxes and international entrepreneur taxes at www.htj.tax. Number 2. Stream premium educational videos at www.htj.tax. Number 3. Contact us for tax optimization consult over Zoom. Number 4. High net worth. We can quote for doing your US international taxes returns. Our books and upcoming event are available at htj.tax. Please subscribe, like, share, and comment below. Email us at help@htj.tax to engage us, to advise on international tax or business matters.